Michael Frazis now from Frazis Capital Partners. He joins us here in the studio. And Michael, it's a pleasure to have you on the show.
Yeah, thanks so much.
Thanks for joining us here at Ausbiz in Barangaroo. But let's talk a bit about what we've been seeing there, because we see all the civil unrest in the United States, and certainly we're starting to see futures in the US take a bit of a dip off this. But there's a stock that you watch in the United States that I guess could benefit from this. What are you watching?
Exactly. It's called Axon Enterprise. So basically what they do is they do body cams for police officers and also tasers. So it's very much non-lethal force, so it kind of ticks those ethical boxes. If you're looking for a way to play that kind of defence enforcement theme. But obviously they're growing very fast in this environment, and that's only going to continue. And you can imagine how much data a company like that generates. You know, it's all the video, all the audio. Yeah. They bring it all together on like an online evidence.com platform. So it's a very interesting company in that regard.
And we can see some of the footage right here on our screen of some of the protests going on. That's, of course, not coming from the police cameras there, but it is interesting to see as we get more and more footage coming online and more access to all of the news flow that some of these particular products, they could continue to actually go up in value, as you say.
Yeah, absolutely. I mean, it rallied very hard last night, up about 18%. But I think people are realizing, you know, people need to be monitored. You know, enforcement needs to be monitored. If there's video and there's audio, that's quite compelling. It makes it, at least when things go wrong, you know exactly what happened.
Well, horrific vision. We'll move on from that for the time being and talk the recovery from the pandemic, because, of course, this is something else. I mean, we've got so many sort of tales going on in terms of risk at the moment. There's risk off in some sectors, risk on in others. Of course, we're coming through the other side of this pandemic, and people are wanting to know how to play the recovery story from a health perspective. What sort of stocks do you like as we come out on the other side, economies reopen around the globe?
Yeah, I think the most interesting ones are the ones where the revenue just got wiped to zero effectively.
Yeah.
And that's probably when you saw the sharpest falls and you'll see the sharpest rebound. So there's companies like Six, which run theme parks, companies like Vail, which run resorts. There's a company called Live Nation, which does effectively live entertainment. So they'll do deals with leading singers, you know, the top tier in the US. They'll own kind of stadiums and concert halls and bring it all together. So those will probably rally very strongly as the recovery continues.
Have they started a recovery yet in terms of their stock prices?
It's strongly off the lows, yeah, okay. But they're still down significantly. Yeah. So you're still looking at, yeah, I mean, an example would be Sabre, which is a software company. You know, that dropped from $20 to $6, $7. So if there is a recovery, you're still looking at 2 to 3x. Most of the high quality ones, you're looking at much less than that. But to be honest, in this kind of environment, you probably want to stick to the high quality. So if I had to pick one, it would probably be Disney. I mean, that's a company, it's trading about $150 and it dropped to kind of 80, 90. We're buying in the low hundreds. You think what happened there, half their profit comes from theme parks. So that effectively got wiped to zero. But while that, and the stock kind of followed that. But over the last year or so, they've launched Disney Plus. And they've got 55 million subscribers in less than a year.
And what was that? Was their target was to get to about that amount in 5 years or something, wasn't it?
Yeah, I mean, well, Netflix is 180, so that's kind of like the top range. So they did almost like a third of Netflix in substantially less than a year.
It's just all the people with kids at home, I keep saying. They just were like, what can we do to entertain our kids? Disney Plus.
And it's so compelling. I mean, it's not just Disney, it's Marvel, it's Pixar. They've got a deal for The Simpsons. They can bundle ESPNs, they can bundle sport with it. So this part of the business is growing extremely rapidly, while theme parks have been written down to zero. So you can imagine in the next 1 to 2 years, Disney Plus will continue to grow because it's such a compelling offering, but theme parks will come back online as well. So you could see that lift from $100 to $200 or $300 kind of in the next 1 to 2 years.
With these companies, they're probably going to be at the forefront of coming up with solutions to be able to allow thousands, tens of thousands of people to be in a confined area at one time. Have they released the method, the solution that they'll be able to actually implement this?
I think they're trying. I think they're trying to figure it all out. But ultimately, at some point, you know, these things will reopen. Like we know as a fact, like life will eventually return to normal in this regard. So it's almost, you know, very high degree of certainty at some point that these things will be back online as they were. And there's probably a lot of pent-up demand as well. So they might actually have 1 to 2 years that are extremely strong, you know, ahead of where they were before. So that's kind of what to look forward to with these plays. And then I guess you have a choice of going, you know, Sabre, which is airline software, which, you know, is a leveraged company, you know, question marks about how long it survives. Then you've got companies like Disney, which are robust, rock solid, but you're probably getting less of an uplift. So it really depends where you want to be on that risk spectrum and whether you're willing to take the risk that, you know, we get a second wave and, you know, airline recovery is much slower than people expect.
I know you've talked Shopify to us in the past. It's interesting, this whole sector's done pretty well in a pandemic, sort of held on. What's your take on Shopify and these sort of stocks going forward?
Shopify is pretty highly valued now. I feel like some of those moves are over. What it does kind of show is, when you get these big dislocations, generally the best way to do it is not to go for the recovery play. Don't go for these stocks that have been, dropped 70, 80, 90%. You're probably better off going for the companies that are booming, that are going to accelerate in that environment. So there's a number of e-commerce players that did that, like Shopify, effectively the Amazons of South America, MercadoLibre, an equivalent company in Southeast Asia called C. Digital health players exploded. Many of those companies went up, 50 to 100% or more throughout the crisis. So you're probably better off, really thinking about where the money is flowing and then trying to figure out which company's going to benefit most. And I've found that to be more productive than going for the recovery plays, going for the distressed assets.
What about in terms of where you look? Because I'm just hearing here, you're quite diverse, right, in terms of your global exposure, I assume. Do you look at Australia much, or is that sort of...
We do. We're technology and life sciences.
Yeah.
So companies like Afterpay we've owned for a very long time. Xero we've owned for a very long time.
Yeah.
Xero is an interesting one. I think it's still quite misunderstood. It just kind of encapsulates why there's such a disparity and so much kind of debate in the investment community. I think what happens in Xero, if Xero gets a new customer, that person might be paying $30 a month for the rest of the life of their business. If they have a new subsidiary, they'll be paying $30 a month. If Xero raises their prices, they'll be paying that. But you can't see that anywhere in their financial statements. I think we'd all agree that customer is worth a lot, but it's literally nothing there. In fact, the only thing you will see is the marketing expense it took to win that customer. So if somebody was looking at historic financial statements as a way of determining the value, they wouldn't actually see any of that. There's a number of situations, particularly in technology like that, where there's huge amounts of hidden value that you're not going to get just by doing traditional analysis. You have to really understand how the companies work and how value is created. And so there are examples in Australia like Xero of that.
And does that mean that their acquisition cost really is as high as that $30 a month? Is that what you're saying? Or is it more the fact that we just simply can't get the true reflection of how they estimate and value those particular parts of the chain?
Yeah, well, I think it's more like, let's say you do sales and marketing expense this year. You'll see that in the historic financials. But let's say that the customer signed up, the last day of the financial reporting period. You won't see anything from that. You won't see any revenue. Most of these software businesses have very high gross margin. So often that revenue is very close to a kind of, early profit measure. You just won't see that. You have to look carefully and understand how it's working.
So where else, and besides just geographically, the US obviously has a lot of exposure to tech and life sciences. Yeah. Where else is there? Do you look at Asia at all?
We've had two companies. So C, which I mentioned, there's a company called Pinduoduo.
Yep.
They took 10% market share of Alibaba in 3 or 4 years. And almost nobody seems to know about this company. I can imagine how hard it would be to take 10% of Amazon's share in 3 or 4 years, or Woolworth's share or something. It's very hard to do these kinds of things. They're doing something truly interesting and truly unique. I think people need to kind of understand how they're operating that model. So what they've done is if you think about Amazon, Google, Alibaba, like that kind of e-commerce model, it's all based on the search bar. So if you want to see something, you'll look up, cars, and you'll get your list of cars, and it's all search done, which is very good for advertising. It's very easy to show people cars when they do that. Pinduoduo is a different one. Pinduoduo tries to make it fun. They hide the search bar. What they want you to do is scroll through it, and then deals will come up, and you'll be encouraged to club together with people and get discounts. And every time you add somebody to your buyers group, the price will go down for all of you.
Right.
It's fun. It's flashing lights. People are spending 3-4 hours a day.
Where's it listed? It's almost like a social media
US
app.
listed. US listed.
US listed.
That is the idea, yeah.
Right, okay.
So everyone's tried to combine social media and e-commerce. These people have done it. They've figured out a way.
Right.
10% of Chinese market in a few short years.
I love that. That sounds like a really interesting play.
To me, it sounds like the complete opposite, but I guess I don't spend as much time.
It sounds like the future.
It does.
That sounds like
I think that is true. Invest-wise, definitely the future.
Yeah, and the stock has ripped as well. It's something like triple over the last short period where markets have been down.
Amazing.
So people are starting to see that value come through as well.
I love some of these ideas. Michael Frazis, really appreciate your time on the
Thanks
program.
so much.
Thanks for joining us.